But I'll just start with the introduction here. I think what Robert was saying and what economists generally believe is that debt, when it gets to beyond 90% of GDP, starts to hurt economic growth. And the pandemic and other factors have increased debt levels quite significantly. It's interesting when you look at Nigeria as one outsider, where their debt to GDP is at 34%. And then you go to places like South Africa, 80%, Ghana, 84%, Zambia, 117%. But I believe we need to put this into context when we start looking at China, 69%, UK, 85%, France, 115%, USA, 125%, Italy, 155%, and Japan, 256% of their debt level as a percentage of GDP. So this is not just an Africa context in terms of where debt levels are. This is a global phenomenon. I think we all agree here that Africa needs infrastructure. And I think we all agree that its infrastructure is not going to be given to it for free. No one is giving, not even the Chinese are giving 100% grant and saying, we'll build this road, we'll build this hospital, and you don't have to pay for it. So if no one's willing to do this for free, then Africa's going to need debt, particularly given that most of the infrastructure we were discussing yesterday is at a sovereign level. So this session is going to be talking about how can we do this sustainably, given the points that Robert has just been making. What can the banks and the export credit agencies do? What can the OECD surrate and other forms of financing and concessional financing do to assist, and how the private market insurance can play? So, and we also have, I've just seen now, Brad, who's the Executive Director for Aid Data, join us. So without further ado, I'm going to go to you, Ainal, if I may. I always like to start with the bankers, and I'm not going to bash you, as I was accused of yesterday. But as a banker, and you're looking across Africa, and you're looking across social infrastructure projects, what's your view about debt sustainability and about increasing the debt levels so that African sovereigns can have the social infrastructure it needs?
Good morning, Gabby. Thank you to the panel, and thank you for the opportunity to be here. Gabby, that's a very interesting question because, as we all know, we see the sovereign debt levels climbing. There seems to be limited cap or ability to cap those debt levels, particularly when it comes to a debt to GDP level. We are seeing strains on the sovereigns, particularly in terms of their hard currency borrowings and their ability, number one, to service interest, then to service capital in respect of those underlying borrowings. So there's a host of measures that we are looking at, and that the banking community, together with the ECA community and the DFI community, are looking at in terms of how we structure these infrastructure deals so that it is optimally structured. Number one, for the borrower, number two, for the project, but then number three, for the sustainability as well of future lendings going forward. And Gabby, there's a number of risk mitigants and structures that can be used in the process, including, tenor, so that we increase the tenor of these projects, so that we make the debt repayments affordable and sustainable. Number two, and most importantly, that concession returns are provided. And then number three, I think for our purposes, what has proven to be particularly useful is the direct lending facilities and lending at the transparent SIR rate of the ECAs that has made some of these project financings very viable. And Gabby, also to add, in terms of structuring the underlying financings, we must also pay attention to structuring a local currency tranche, because at the end of the day, we need to evolve from hard currency borrowings into local currency borrowings, so that the debt that these sovereigns and borrowers are taking on balance sheet is actually sustainable in the long run. So just a high level, some of the mechanisms that we're looking at and how we're structuring the actual financing in regard to these long-term, in order to make the financing, sustainable for the borrowers of record.
So I know I could summarize that by saying we've got to go long term and we've got to go cheap. Yes. So I just asked the question back to you. How does that fit with shareholder value for a bank, where you would want short and expensive?
Yeah, it is difficult, particularly given a bank such as ourselves. So we are a South African and African bank, and we have a local currency balance sheet. So hard currency lending is more expensive for South African or African banks. Having said that, there is value to be had because there are various roles that a bank can play in structuring a project. And at the end of the day, it's about those value-added roles and value-added services that actually deliver a shareholder return from an internal banking perspective. Okay, so it's not about lending cheap, long balance sheet, because you must remember we're governed by a host of regulations at the end of the day. But it's about structuring so that you each reach that optimal solution between what a bank can do and what the rest of the community can do. And the interface between the two is absolutely important. Having the technical skills and the ability and know-how and knowledge of a commercial bank on a transaction is absolutely invaluable and vital to structuring that optimal solution. So banks welcome direct lending tranches, I say, because there is opportunity for banks to lend in local currency. There is opportunities for banks to lend under buyer credit facilities, for banks to apply risk management solutions so that they look at cash flows, for DFIs to come in and take tail in risk. So it's not an exclusive situation. Banks can work very meaningfully and very significantly within the wider ecosystem to provide for that optimal risk solution.
Okay, thank you. So, Portia, welcome you here as the Business Development Head of at ECIC. You've heard Ainal talk about the importance of structuring, the importance of tenor and price. What is it that ECIC does as the South African Export Credit Agency that will assist that, both to support South African exporters, but also really in terms of a wider Pan-African basis?
Thank you, Gabby. So I think from the ECIC perspective, I'm pleased to say that, and I'm glad to hear Ainal speaking about longer tenors. In that regard, we've been a market leader when looking at sovereign projects on the continent. We've had requests in the past where even a client wants to go out to 15 or 18 years, and we've come to the party and quoted for, those tenors. And where we struggle is sometimes, as Ainal said, the banks are only willing to go for shorter tenors in comparison to what the ECIC is prepared to cover. I'm glad to see that there is an understanding now that we need to be able to support these longer tenors to assist these sovereigns. You find that a lot of projects fall into or run into trouble, and the sovereign ends up looking but not looking very good, if I may put it that way. But if you look at it from the inception, the problem is that they would have been given 8 years to repay for the debt repayment, which wouldn't make sense when it ought to have been maybe 12 years or so. So it's good to see the financial institutions come into the party in that regard. As ECIC, we also open on the majority of the continent. I think there might be less than 5 places where we may not venture to go. And we play an active role from the business development side in terms of encouraging financial institutions, bringing opportunities to financial institutions that they can consider to fund, as well as sharing opportunities that we come across first with the market or with South African exporters to try and encourage them to do more on the continent. In terms of ECIC based in South Africa, we're supporting South African manufacturers and we're supporting financial institutions that are registered in South Africa. Historically, you've seen that a lot of the appetite and activity is limited to SADC. And we've taken the lead as well in terms of with our originators, finding opportunities and trying to match those with South African contractors and as well as financial institutions. And I'm pleased to see that there is some traction in that regard, and our pipeline is growing and starting to execute transactions, perhaps in Francophone Africa, which was not a very popular area for a lot of the South African financial institutions as well as South African contractors.
Okay, thank you. Nick, you've heard bank, export credit agency from a sponsor, business developer, NMS International. Do you think that you're getting the right liquidity and the liquidity needed going forward, given the constraints that we've heard earlier?
Well, I was very glad to hear Einal say that we can go longer tenors. So I'm assuming that means that on the Thai commercial loans, we can match the export credit tenors. So I'm very glad, and I'll take that up with you, Einal, later for one of the project that we're talking about. So thank you for that. I'm sure everybody heard the same thing. It's not a question, I don't think, of liquidity. I think we're finding that the liquidity is out there. I don't think it's a question of projects. The projects are there. There's more work than anybody can actually do at the moment. So I think it's more to do with the ability of the countries to actually put that debt onto their sheets. And I think that one of the areas that we're doing a lot of work on at the moment with our clients is looking at what is good debt and what is bad debt. Good debt coming onto the books, agricultural programs, for instance, which increase the income coming in from exports. And I think what would be very useful is for the institutions, and particularly people like the IMF, etc., to actually split and look at the debt that's being taken on as to whether that is debt that will help the economy or debt that is a block to the economy. And I think that the whole question of sustainability, it's sustainability of debt, yes, it's sustainability of the project as well. And we need to look at that as a holistic, rather than in the past where we've looked at, is this project good? And then separately, is the debt good? So we've got to match it together. So no lack of liquidity, I believe. We're talking about insurance later, which is a different problem. And certainly no lack of projects that need to be done on the continent.
So I assume that when you're saying good debt, this is debt which is linked to infrastructure projects where drawings of the financing is undertaken in parallel to the delivery of the program.
No, yes, partly, but also what effect on the economy does that project have, and therefore what effect does that debt have on the economy? And you build a road, yeah, which is not a fee-paying road as such, or you build agriculture, which is exporting that agriculture and bringing money back into the country.
Okay, yesterday or the day before, actually, the OECD have made the announcement that they're moving the level of cover from 85 to 95. And very interestingly, from a South African perspective, that there is now the creation of the OECD SIR in Rand, South African Rand, which is a first. I'd be interested in people's viewpoints as to what those implications may mean.
From our point of view, and I'm going to have a bash now at the ECAs, the length of time that it takes to get the ECA on board is so long that our clients are looking at us after sort of 10 months from contract signing, saying, where are your bulldozers? Why aren't you actually on site? And so we try to do the delinking. We can get the 15%, we can get the Thai commercial loan in there much quicker, so long as we can build a completed unit with that money. 95%, we can't do that. We then have to wait all that time for the ECAs to come on board, and that's a problem. So from our own point of view, the announcement from OECD is actually not very useful.
Wow, that surprised me. I know.
Gabby, it's an interesting one, but I just want to comment, sorry, and sorry to steer off course. I will get to your question, but I just wanted to say to Nick, I wholeheartedly agree with these previous comments in terms of are the projects that are actually being financing uplifting the entire economy. And I don't mean if they're revenue generating projects, because they can be social infrastructure projects as well, but there's a difference between those versus vanity projects. And the quality of the actual infrastructure is very important. And we need to be responsible financing community and make sure that, you know, we're participating in projects that actually bring about the upliftment of the total economy and its people. So just wanted to agree with Nick on that one. And Nick, I understand where you're coming from in terms of your second point, in terms of the timeline. It's interesting because I actually see the direct lending in the South African context as being a potential gap stopper for those social infrastructure projects that the commercial banks are not financing. So vis-a-vis the fact that the South African market is very deep, it has lots of liquidity for certain projects, such as the renewable energy projects. Round 5 was just announced last week. The preferred bidders, 25 projects were announced or against different technologies. And those have priced significantly cheap, you know, given where the market is, and at long tenors as well, up to 18 years. But notwithstanding that, and notwithstanding, you know, the primary and the secondary market that stands behind those infrastructure, you know, projects in the South African context, I still believe there's a stopgap solution in terms of where SIR lending and direct lending by the ECAs can be very useful, particularly from a South African government point of view, because we have hospitals, because we have border posts, because we have you know, roads and rail upliftment, critical infrastructure that is falling by the wayside and that is not being commercially financed at the moment for one or a number of reasons, including the bank's overall appetite towards the sovereign and risk thresholds. And I feel that that direct lending could play a meaningful role in those types of projects, per the government's infrastructure rollout plan, where they have now a new office that is dedicated to looking at these types of infrastructure. So it also has to be seen in the context of what is required and where the financing is being applied and where this financing can be applied.
So Aina, can I summarize that by saying not only do you want it long dated to make it fit and become affordable for the sovereign, but really from your bank's perspective and from your own personal preference, you believe that we should be doing SIR funding, direct lending funding for all social infrastructure projects in Africa, because it's the cheapest form of debt.
Gabby, in collaboration with other tranches as well, absolutely. We need to structure, we need to actually think and apply our minds and structure for what is optimally acceptable in the risk matrix, and taking into account the fact that we need sustainable debt finance. So, absolutely.
Portia and I worked together many years ago, and she's looking at me as if to say that's the worst question, because you can't provide SIR, can you?
No. I'm wondering what the implication is for us as well, like looking at, you know, European ECAs now covering 90%. As you know, recently we've been collaborating quite a bit with all of the international ECAs and coming in and topping up on the down payment piece. So that part is interesting to me. SIR, yes, not a benefit from us from an ECIC perspective, but I think I echo Ainal's point that if there is availability, especially for those type of projects that are not sexy enough for the commercial banks, for the international ECAs to come in for sustainable lending, for the hospital development projects and the like, then it means if sovereigns can get funding at attractive rates for those type of projects, it actually increases their capacity in any case to do more projects. So it's still a win-win, and obviously for us, we'll always be looking for a role for South African exporters. I mean, the other thing I just want to touch on what Nick has said, from a timing perspective as well, we as ECIC have worked extremely hard. And I mean, the banks will tell you we worked on something recently with quite a few local banks, and RMB was a participant there as well, where we executed in just over 8 weeks. So really working on being responsive to the markets to try and get transactions executed in timelessly, so that it also makes sense for all the parties that are involved. But yeah, for me, I do see it as a positive thing that the SIR rate is coming into effect, and I'd like to be watching it closely and just see what impact it has on the continent. I'm sure it will be a positive one. I actually welcome the announcement.
Okay, Brad and Sam, I promise I will bring you in, but I just want to pick up on this point that you made, Nick, about good debt. I've got no tangible evidence of this, but from my own experience, I find that when a country goes into default, it does actually keep preferring to pay the good debt, and the bad debt is the stuff that goes into default. And I know both you and Sam, you've got experience of Zambia. So I was wondering if you could share your own experiences in terms of what you've seen for projects that you've been doing in Zambia.
Yeah, I mean, Zambia is a classic example and is recent. So when they had that blip, let's say, continuing blip, what did they pay? So they paid UKF because that was hospitals and that's helping their economy. What didn't they pay? They didn't pay roads, for example, where it didn't have that much of effect. So I think that the argument on good and bad debt is as Einal said, it's the effect on the economy rather than revenue, direct revenue earnings. And it is a major point. And I think we need to persuade our friends at the IMF, as an example, that when a country has pushed up its debt ratios and it's got no non-concessional limits left, you can get a waiver for projects, social infrastructure projects that is making a difference to the economy. Because otherwise, we're going to come to a grinding halt.
And Sam?
Yeah, I think obviously Zambia had the default last year, just under $16 billion. I think, certainly it's a good example that the private insurance market is supporting, all the activity and projects and infrastructure across Africa. And of the $16 billion of debt that's being restructured currently at the IMF, we estimate in the CPRI market to be just shy of $1 billion of exposure. So that's no small amount, and I think that's an indication that there is a clear and continuing support, and the anticipation, I think, from insurers and the wish is that a lot of that will be recovered because a lot of it was quite well structured. So, they anticipate, as has been our experience across the African continent, when there's been defaults, that payments come in eventually, and sometimes there's even an upside for the insurers.
And if I may, and I don't know whether you can answer this, but because you insure both commercial and you do reinsurance for the export credit agencies.
Yeah.
And if you take Zambia as a case, have you seen any of your reinsurance of the ECA debt to Zambia? Was there any default on that?
I think it's also being restructured just because, of the liquidity problems. So that's definitely in the offing at the moment, and it's a bit of a wait and see. But those payments, I think, have been missed, and it's a question of, ties into what the panel have been saying, particularly about longer tenors. And I think the private market is responding well. I talk with my, obviously, insurance hat on. The private market is responding well to supporting commercial banks and ECAs in doing longer tenors. I mean, 20 years behind an ECA is achievable, and over the course of the years, the tenors that the private market can do for commercial banks has increased, tremendously.
So $16 billion is what government of Zambia went into default. You were halfway through a project. Did you have UKF issue a cross default or a draw stop on you?
No, we didn't. We had lots of discussions. There was a period of time where I think we were concerned, but there's been no draw stops. And I think we're on a straight path through now. UKF have been very supportive of this particular program, but of Zambia as a whole. I think the situation has changed dramatically in the last few months with the new government. This new government is now talking. The IMF program is on the way. I think the situation has solidified really quite well. So I think the risk of interruption to our program or any other programs is diminished.
Brad, I'd like to bring you in here. Sorry.
Sorry. I was just going to add to that point. We have quite a bit of large exposure in Zimbabwe, and we've been covering projects there when no one else was willing to go into Zimbabwe. And I think the key thing, and I think Nick touched on it, is about communication. We had a few inquiries around Zambia, and there were some projects that we were quite keen to pursue and we were willing to consider. But what gave us pause in those periods was just their inability to, or refusal actually, by, to engage and to discuss and play open cards. And I think that's probably, if there had been initial discussions or engagements, we would probably be still on cover there. And I would expect that some of those projects would have still been restructured and would not have gotten to the stage that it reached. And it's very important to play open cards and to communicate with one's creditors about the challenges that they're seeing. I mean, to give that example with Zimbabwe, where you may know that they are in trouble, but you will support certain projects, and you know that by supporting those projects, it's going to actually open up the economy, it's going to put them in a better position to earn revenue, to do better, and to increase the growth of that economy. So especially for us as ECIC, we do want to support sovereigns, and you can have funding for sustainable and create, it can still be sustainable even if the sovereign is considered to be, I would say, in trouble. And I think that Zimbabwe Zambia would be a good illustration of that. Even the recent transactions where, RMB and other South African banks have come to the party. RMB, we worked with them recently on a project for the Bay Bridge border post as well. So that communication is very key.
Thank you. Brad, it'd be good if you just give a little bit of background about yourself and aid data, and then answer the question regarding, do you see a difference between good debt and bad debt?
Yeah, thanks for having me. So I am the executive director of a research lab at a public university in the US called Aid Data. We, among other things, track Chinese aid and debt-financed development projects all over the continent, as well as other regions around the world. With respect to the good debt and bad debt issue, I very much affirm everything that's already been said. I mean, I think there is a very important distinction to be drawn between, revenue generating projects and projects that have a sort of economic multiplier effect. And one of the things that we do here is geospatial impact evaluations of infrastructure projects, where we're using high resolution satellite imagery to look at the economic benefits that accrue to local communities alongside infrastructure corridors. And that's one way, to be able to differentiate, between a debt finance project that is or is not, having that kind of economic multiplier.
That's interesting, because I was reading, and I didn't read the full report, I hasten to add, but summaries of a report by Ammar Malik, who looked at, or was the co-author of the Banking on the Belt and Road. And one of the statements that came out of that was that the report said China had quickly established itself as the financier of first resort for many low-income and middle-income countries, but its international lending and grant-giving activities remain shrouded in secrecy. So I'm interested on that on 2 points. One is the first resort, i.e. it seems to be first in market. And two, that there is an expectation that everybody should know about the financial details of one sovereign to another, which I kind of question, really.
Yeah, I mean, I think the reason why we use that term financier of first resort is because we just see China outflanking its competitors on the affordability dimension and on the speed dimension. I mean, there's just less hassle factor working with Chinese donors and lenders, especially on the front end. China's different because the state is very actively involved in orchestrating package deals that involve financial contributions from multiple government entities or state-owned entities. So for big ticket infrastructure projects, it's not at all unusual for a so-called mixed credit to be provided, where you might have several loans, maybe an RMB denominated concessional loan, a USD denominated preferential buyer's credit and or a non-preferential buyer's credit. And sometimes you even see the Chinese government through the Ministry of Commerce throwing in top-up funding in the form of a grant. And the speed with which they're able to assemble these deals, I think, is kind of too difficult for a lot of these sovereigns to pass up. And I think that active orchestration role that the state plays is really one of the central reasons why it has managed to sort of establish itself in this financier of first resort position.
That sounds like the most excellent form of joined up government, where you have different interested parties from government agencies working together to support their industry, being first through the door. Wouldn't that for you, Nick, sound like manna from heaven?
There are very few times when we can get joined up government. It actually works very well, but I haven't seen it very many times. But I think the point on China, one of the points on China is the speed. And we've talked about it many times before. We'll talk about it many times in the future. What we've seen projects where we've been working in parallel to Chinese companies, not on the same project, where they've got their bulldozers rolling in 3 months, and where we haven't even got a letter of intent in 3 months. So, and then we get the customer coming back to us and say, "What the hell? China have been able to do this so quickly," and that loses us work because, as you say, China's first port of call. It's not on quality, it's not on liquidity or on cost of funds, it's speed, and we are well behind the curve on that.
And that's interesting because, I have to admit, it's been a few years since I've been to Beijing, but every time I went to Beijing, I was always immensely impressed with their infrastructure, which seemed to be light years ahead of what's happening here in Europe. So I think, the rhetoric of saying that China doesn't produce top quality, I think is a little outdated with respect.
Oh, I'm not saying that they don't produce top quality. I say that the argument as to whether you go to China or go to Europe isn't about quality. It's about the speed of getting the funding in place.
Brad, would you like to come back on that, or maybe I'll ask a question: is it just purely about speed, or is it an issue of lack of transparency? Do you think that China is doing something that it shouldn't be doing?
I think that actually is a very different question, right? It's less, less about why are they the financier of first resort, and more about, how has their engagement created some problems for sovereigns and for other creditors. And I think we make a big point in this new Banking on the Belt and Road report about the secrecy that surrounds China's overseas lending activities. And we say, look, the secrecy actually makes it more difficult for bilateral aid agencies, multilateral development banks, others to not only determine how they compete, but also how they might be able to coordinate or collaborate with China. So we do this deep dive on we gained access to about 100 unredacted loan contracts between Chinese state-owned lenders and sovereign borrowers from 24 countries, many of which are in Africa. When you peer inside the contracts, what you see is that China's really taken three specific measures that make it difficult for other creditors to compete with China or coordinate or collaborate with China. The first is the confidentiality clauses. They have extremely expansive confidentiality clauses that bar the borrowers from revealing the terms or even the very existence of the loans. So that makes collective restructuring really difficult, as we're seeing in Zambia, because these confidentiality clauses are not boilerplate. They bind the borrower rather than the creditor. The second thing that's pretty unique is they explicitly include no Paris Club clauses and no comparable treatment club clauses that prohibit the sovereign from restructuring their debts in coordination with other creditors, right? So that makes it very difficult to sort of coordinate and collaborate. And then the third is collateralization, right? So Chinese debt contracts, they usually contain provisions that really try to position the Chinese state-owned banks as senior creditors, and they're usually collateralizing on liquid assets. Usually it's a minimum cash balance requirement in an offshore lender-controlled bank account that they can, seize in the event of default, which is not that unusual, right, in sort of a no recourse or limited recourse project finance setting. It's pretty rare, with official creditors, so when you're thinking about China vis-a-vis other official creditors, it's effectively kind of positioned itself at the front of the repayment line because the other official debts are increasingly considered to be junior debts, right? And China's debts are senior because the other official creditors just rarely collateralize. So I think all of these factors, the confidentiality, the no comparable treatment clause, the collateralization piece, all of these things are kind of rearing their ugly heads now as sovereigns get in over their heads and have to try to find a way out.
Brad, you need to be looking at here in the UK. Here in the UK, there are 700 PFI PPP projects. The total amount of those projects is about 60 billion sterling. There is no transparency on these projects. There's actually the Infrastructure and Project Authority and the National Audit and Cabinet Office have one person who's assessing these 700 projects for a value for money basis, i.e. there is no evaluation on value for money. And, we've got projects here. We've got a PFI project. There's one in Liverpool where it got taken back by the government, and the government is still paying something like £4 million per annum for an empty school. So, I don't think that the problems that you've just raised, I fully understand that, but I think it's a worldwide problem, both here in the developed as well as in the developing market, and I think that's a question more about the value for money evaluation of PFI PPP more generally, but that's my hobby horse. What do you think, Nick, about PFI PPP? Do you think that is a way that can help projects in Africa get off sovereign debt and become truly off balance sheet?
I mean, we regularly asked to look at PPP projects. I think it's really difficult. But on the continent, if you talk to 100 people, they'll give you a different definition each time of what they believe that to be. I think if the funding communities could come to the party a little bit more on PPPs, it's the amount of time and effort to put in place the information that is needed to fund these programs, where you actually can't get a lot of that information from the markets, because from the country markets, because it just simply doesn't exist. The legal frameworks are beginning to improve. We're doing one in Senegal at the moment, where it does seem to, in fact, we're doing it with INL. It does seem to be getting there, but it's being backed. There's a backstop. There's a government backstop to it. If that was by itself without the government backstop, INL, I think that would be problematic.
Absolutely, Nick. Given that it is social infrastructure and that it's not revenue generating, at the end of the day, we need security and foresight and certainty on those cash flows to repay, public commercial debt. So absolutely. But Nick, I was just going to say, in terms of the PPP structure and the overall standardization structure, it is structured. And by the way, that mechanism and that framework is used throughout the continent and used very successfully. Because of the private party, involvement and the value for money aspect, the three pillars of the private party public partnership being so well achieved. But the one thing I wanted to say is that if you structure that contingent liability, i.e. the government liability, correctly, it should show minimally in terms of its balance sheet obligations. So it's direct balance sheet obligations, and it should form part of its overall budgetary allocations on a per annum basis, because your unitary payments need to be accounted for in that department's budget, which is approved by a parliamentary process for every period, whether it's on a per annum basis or 5-year basis. So I still do believe that PPP framework is actually ideal for governments, because governments don't take the whole of that debt quantum onto their balance sheet day one, and the way we structure it as a contingent backstop liability also provides the government with debt sustainability management and breathing room in terms of its actual infrastructure rollout. So very, very important to bear in mind.
Does the insurance market look at that in that same way? Treating it off balance sheet or not fully on balance sheet?
Well, I think the insurers will look at most things, and they're very happy to and do work in conjunction. Excuse me, with both the sovereign obligation and the commercial lenders as well. So they're very much open to all of those, and are heavily involved in most of these projects behind the scenes in Africa. Obviously, the insurance is a silent, confidential product. So it's not always known the amount of the involvement of the insurance market. But I think an important statistic, we've got at BPL about 52 billion of exposure for our clients in the credit political risk market, and of that about 9, globally, but in Africa it's the single largest exposure for one continent at just under $10 billion. So I think it shows there's a real appetite for African risk. We did an analysis of the claims, because let's face it, the insurance product supporting a lot of these ECAs and the commercial lenders is only as good as the claims that are paid. And since 2007, we've had collected 153 claims for just under $1 billion. But of that global claims amount, in Africa for export finance, there were only 12 claims. And since 2007, for about 35 million, it was fully paid by the insurers and then recovered at 95%. So you can see why there is a real desire for the private market to support, and why it is supporting ECAs and the commercial lenders as well.
I'm afraid we're running a little bit out of time, and we haven't got any questions. So I'm going to give a question to each of you. Or I'll give the same question, but we've all heard that we need 50 billion per annum of infrastructure. We all know the problems, and we've been listening to Robert earlier in terms of the issues in terms of debt sustainability and the debt levels across Africa. If you had a magic wand, what do you think we should be doing, or what would you like to do or see that would enable Africa to have the infrastructure without causing the real pain in terms of increased debt levels at a sovereign level?
I'll start. I think the first thing is a significant reduction of ECA premiums. The premiums do cause significant difficulties. It's in the eyes of many people, it's wasted money, and they are very large. So I think a reduction of premiums, of course, extending tenors we've talked about, and then my old good hobby horse, which I know you share, one concessional lending product for UK. That is going to cause us a problem in a couple of years' time if we don't have one. And of course, more direct lending, and Idle mentioned that before. Direct lending and the sustainability that brings is, I think, vital as well.
Portia?
I think from my perspective, I would like to see, I was going to say, I'm sure Nick will agree that our premium is very competitive. So I wasn't going to comment on the premium, but I would like to see, more competitive lending rates from the financial institutions that we work with, supporting those projects, and almost in the ideal world, a marrying of viewpoints where we all recognize that it's important for infrastructure development to take place. And as an ECIC, we keen to support, and we there with exporters, we will put out a letter of intent, we will do whatever it takes to help, the project come on board. But we cannot legislate to the financial institutions about the type of projects that they can support. So it would be good if we could have a meeting of minds in the meantime before we're also able to come in and provide direct lending, which is something on the cards, but still a long way away.
Okay, so the hot potato is now with you, Arnel. It's down to you to reduce your margins. What would you like to see?
Point taken. Gabby, there's so much I'd like to see, and I don't obviously concur with and support what Nick and Portia have already said. Perhaps also to add that there's so much to do. The pipeline is so big and enormous. Surely that requires more collaboration from the likes of the commercial banks, the ECAs, the DFIs, the multilaterals, the non-DFIs, but developmental mandate type institution, and impact capital as well. And I don't see that coordination. Each group or each fraternity works very siloedly, and yet if we came together, we could divvy up, what risk appetite we had along the spectrum and say where we could or could not participate and what we could or could not do, even as amongst the commercial banks, too much competition as opposed to collaboration, with banks wanting, to lead and not to club. So I really do think the mandate, the ask, the task requires a different approach, given how much we have to do.
Okay, thanks. Sam?
Yeah, I think I'd echo what Inal has said, and there needs to be more joined-up thinking. An immediate issue in my market is there's a bit of a lack of capacity. There's capacity for good deals, sometimes in difficult countries. But if an ECA is coming to the private insurance market on an export finance deal and taking all of the capacity, guess what? There's no capacity left for the commercial bank to do the 15% tight commercial loan financing. And we've seen deals fall away, specifically in the last couple of years, particularly in Angola, where the Spanish ECA is very active. So the lack of joined-up thinking is really hampering some key projects being developed.
Brad, last word with you, but it sounds like collaboration is what is needed, which is very similar to the kind of Chinese model. What would you think is the solution for Africa?
I guess come at this from the demand side. So, I think if I had a magic wand, I would be trying to build higher capacity debt management offices in finance ministries across Africa, because I think that the ability to take on more good debt and less bad debt is to some extent a function of the sovereign's ability to screen out to differentiate between those, those two types of financing. So, I mean, I think there's a really important role for the IMF and the World Bank and some of the bilaterals to play in that regard.
Okay, thank you for that, and thank you for the panel. But before we close, are there any particular questions? I know we're running a little late on time, but I'd be keen if anybody does have a question. Oh, we've got a couple at the end.
Hi, thank you. Thank you for the interesting presentation. Maybe a question for Inal and Portia. We've heard about the coordinated Chinese funding supporting contractors. We've heard, Nick, maybe UKEF's a bit slow, but the backing of UKEF coming into Africa with direct lending, low SIR rates, banks with low cost of funds. I really struggle to understand how are South African and African contractors really able to compete on the continent. With South African banks with high cost of funds, maybe ECIC not with the same tools that some of the other ECAs have. Just to build on that, not just South African contractors, but other African contractors. A few years ago, I was approached by an Angolan contractor trying to do a project in West Africa. Angola has no ECA, and their banks have even higher cost of funds than the South African banks. So, how do African contractors compete when they don't have the same access to export credit finance that European and Chinese contractors have?
Great question. I don't think we have a solution to that, but anybody?
Well, I mean, Michael, as you know, when we do our prime contracts out into Africa, we contract the local contractors. So, I mean, we might head it up, but the work on the ground is done by local contractors.
And presumably now that UKEF the ECAs allow up to 50% local content, has that been helpful for you?
Oh, absolutely. I mean, we had a situation in Zambia, in fact, where we were bumping up against the 30%. We were having to look potentially at bringing in cement from outside of Zambia rather than using Zambian cement. It came in just at the right time, and we've been able to put more money back into the economy out there, employ more people, etc. So, I mean, I think from Angola's point of view, or local contractors, by teaming up with those companies that can get that credit from their ECAs, that's the way to go at the moment.
I think if I could just add to that, sorry, Gabby, also absolutely agree. The localization rules have definitely helped local contractors on the continent to at least win subcontract roles or primary or main subcontract roles, particularly in the civil engineering space. From what I have seen. I just wanted to talk about 2 points as well. So for instance, in the Angola scenario, also approached recently by an EPC that is Angolan, looking at a West African project. And there we scoured the market so for credit risk mitigation and did not use the ECA market because actually there's no natural ECA fit. But there are other forms and other supporters in the DFI market, the multilateral market, and even the private insurance market, including Lloyd's of London and the company markets that are willing to support those projects as well. And I found that those markets absolutely love infrastructure projects, and if it's linked to, as we said, good debt. The other thing I just wanted to mention, and from our previous discussion, Gabby, if you'd allow me, is the fact that the borrowers on the continent, whether they be sovereign, sub-sovereign, SOC, corporate, the borrowers are evolving into a more sophisticated type of borrower, if I could say that, because part of their analysis when undertaking these projects, they do a lot of technical due diligence and look at performance risk of the underlying subcontractors. So now they are contracting or entering into arrangements and relationships with EPCs that have good reputational risk and that have a proven track record. And that has certainly boded well for the African contractors because we know them, we know their work, if we know the reputation surrounding their work and the good standing nature of their companies. So that has certainly helped African contractors. And obviously, as financial institutions, we have whole lists of contractors that we support and we bank, and we obviously promote them as well in terms of our overall, role on the continent as well. So I hope that somewhat answers the question.
It does. Thank you, Arnel. And sorry, I don't. Okay, quick. Is it quick, Ed?
Actually, I was going to ask two quick ones, if I may. But honestly, two. Very quickly. There's special rules for under the OECD for things like water financing, longer tenors, and so on. Quick one for Nick. Given the pandemic, etc., and is it time that there's special rules for health and perhaps other social infrastructure programs for longer tenors, more concessional lending?
Oh yeah, absolutely.
And what's the second question?
And then was Zambia, a question for Brad. You were talking about these secretive Chinese deals. I was with a high-level delegation from Zambia last night, and I just wonder, they've opened up their books. You can see all their loans on the Ministry of Finance website. Do you think, and obviously we've got a new administration in place, do you think that will help to shine a light on some of these practices that's been going on? And do you think it will help to change what China's doing around Africa, these default situations that open up what's actually been happening on the ground?
Brad, do you want to take that one first? Quick.
Yeah, I'm very familiar with what they've disclosed. They've actually not disclosed very detailed information at the individual loan contract level. And I think some of the holdout tactics and litigation tactics that are being employed by non-Chinese creditors are, purportedly because they don't understand what the terms are, or the rescheduled terms are, of Zambia's outstanding debts to Chinese creditors, of which there are many. It's not China. There's probably 24 Chinese creditors. So, I think that this is why the Paris Club exists, right? That we sit down in a venue where we can share information about the debts that exist and the terms that exist. So yeah, I think that remains a problem.
Okay, thanks. Really quickly.
Yes.
Okay, perfect. So apologies for overrunning there, and thank you very much to the panelists and